Most people first encounter the credit system when they try to sign their first lease or finance a car. It's the moment you realize that your ability to move forward depends on a history you haven't even started building yet. In the United States, your credit score functions as a financial passport. It is a mandatory credential required to navigate the economy without facing significant hurdles at every major life milestone. The problem is that many people apply for their first card based on marketing for fast food rewards or shopping discounts. Without a specific strategy, it is easy to damage your financial profile before you reach age 25. This comparison table shows the real-world costs of a poor credit history. Someone with no score or a low score can expect to pay double for apartment deposits and significantly more in car loan interest than someone who managed their credit correctly from the start. These higher prices act as a recurring cost on basic necessities. Over several years, this gap can represent tens of thousands of dollars in lost savings. This video will focus on the mechanics of building that score. We aren't going to cover luxury travel hacks or how to get high limits for the sake of appearances. Because your early credit history determines the interest rates you'll be offered for years to come, your first card choice is a foundational step in your financial life. To manage this system, you need to understand the credit limit. From the bank's perspective, this limit is a measure of how much risk they are willing to take on you. If you are approved for a $1,000 limit, it does not mean you have an extra $1,000 to spend on discretionary items. Lenders judge risk by credit utilization. On a $1,000 limit, staying under $100 shows reliability. Using over 30% signals you're overextended, increasing score risk. High utilization lowers scores, even if paid monthly, because algorithms view high balances as financial distress. Building credit quickly requires you to ignore most of the purchasing power the bank provides. Banks also offer options that can lead to long-term debt, specifically the minimum payment listed on your monthly statement. This graph tracks a $500 balance. Paying the full balance keeps costs flat, but making only minimum payments causes total debt to skyrocket through compound interest. Under this structure, small purchases take years to pay off, costing far more than the original price. Another common error is applying for several cards at once to try and increase your total available credit. Each application triggers a hard inquiry. For a new credit profile, multiple inquiries in a short period look like a desperate cash search, which can lower your score. The credit system is most profitable for banks when users treat borrowed limits as if it were personal income. Choosing the right card depends on your current situation, rather than which card has the most aggressive marketing. If you are a student, your most direct path is a student credit card. These cards have lower approval requirements, but very small limits. This means you must be extra careful not to exceed your target utilization. If you have no credit history and want to avoid debt risk entirely, the secured credit card is the most stable option. You provide a refundable deposit acting as your limit, protecting the bank and ensuring you cannot spend more cash than you have. If you have a steady income and the discipline to pay bills on time, a no-fee cashback card is an option. These cards provide small rewards for normal spending on groceries or fuel, effectively reducing the cost of those items. However, you must pay the balance in full every month. If you carry a balance, the interest charges will be much higher than any rewards you earned. The goal is to find a card that matches your current financial habits and provides the safest path to a better score. After selecting your card, you can use a specific routine to build your credit score over the next 6 months. Step 1. Put one small recurring bill on the card, like a subscription or a tank of gas. Use it for nothing else. Step 2. Ensure that the total amount you spend stays below 10% of your credit limit. Step 3. Set up autopay to clear the entire statement balance automatically. This removes the risk of forgetting a payment and incurring a late fee. Automating these steps converts the card from a potential liability into a consistent method for building credit history. If you are concerned about overspending, use the secured card. The deposit ensures you stay within your means. If you are in college, take advantage of the easier approval for student cards while you still qualify. If you use a cashback card, treat it like a debit card. Only spend what you already have in your bank account. This protocol focuses on discipline rather than the high spending habits often portrayed on social media. Following this routine for 6 to 12 months provides the credit history needed for lower interest rates and easier loan approvals in the future. Your first credit card is a tool for building future leverage. Using it with restraint today means you will pay significantly less for your home, car, and insurance in the years ahead.